Ever since the pandemic faded, we've been hearing about how strong the economy is. Politicians celebrate so-called resilience, while stocks, gold, and Bitcoin break new highs again and again. And yet, life keeps getting harder. Your wages buy less, your debts cost more, the assets you don't own keep appreciating out of reach, whilst the expenses you can't avoid keep climbing. The economy is booming for some, brutal for others, and the split is getting wider. They used to call it class warfare. Now it's been rebranded the K-shaped economy. So, here's how it works and why the strong economy probably doesn't include you. My name is Nick. Stay tuned. Now, you're watching Coin Bureau Finance, where you'll find macro, markets, and all manner of geopolitical topics covered. There's just one thing you'll never find on this channel though, and that's financial advice. And if that's what you want, you're barking up the wrong tree. As for the rest of you, great to see you here. Make sure you're subscribed and smash that like button too. And let's find out what K-shaped means and why it matters more than the old word salad economists used to toss around. So, a K-shaped recovery is what happens when an economy splits in two after a recession. Think about it, a single vertical stem that suddenly diverges into two arms going in opposite directions. One arm trends sharply upward, representing the sectors, industries, and households that are thriving. The other arm either stagnates or trends downward, representing everyone else. The term was apparently coined by one Peter Atwater of Financial Insights, and the insight behind it is simple. Looking at the economy as a single entity is misleading. You have to break it down into the data to see what's actually happening. Aggregate numbers can look fine even while half the population is drowning. So who ends up on which arm? Well, the upper arm is high-income individuals, asset owners, people working in tech and finance, and large corporations with access to cheap capital. The lower arm is lower and middle-income wage earners, people in hospitality and traditional retail, and small businesses operating on thin margins. And if you own assets, or if your income comes from investments rather than wages, and if you can work remotely in a high-value industry, you're on the upper arm. If you rely on a wage, if you work in a sector that requires physical presence, and if you don't own property or stocks, you're on the lower arm. And this has basically always been the case in capitalist economies. The pandemic just shone a light on this sorting mechanism. Now, economists have always loved their alphabet soup when describing recessions. A V-shaped recovery means a sharp drop followed by a quick, strong bounce back, naturally our favorite recession. If you were following financial markets in 2020, you might have fond memories of that epic V-shaped recovery in stocks. Unfortunately, the other letters in this soup are much less tasty. There's your U-shape, which meant a prolonged downturn before things finally improved. A W-shape, meanwhile, was a double-dip recession with a false recovery in between, which sounds a lot like a bull trap to me. And then there's the dreaded L-shape, which indicates a steep drop followed by years of stagnation. But one of these letters is not like the others. All the old ones, L, U, V, W, they're lines describing the trajectory of the entire economy using aggregate metrics like GDP. They tell you whether the economy as a whole was growing or shrinking. The K-shape is a radical change because it's bifurcated, splintering and heading in two opposing directions at the same time. It's therefore describing something fundamentally different, namely the distribution of an economic recovery. Rather than just asking, is GDP going up, it also asks, who benefits? Because this is a different measuring stick, you can have a V-shaped recovery and a K-shaped distribution at the same time. The official numbers can say everything is fine, whilst millions of people experience the opposite. And that's exactly what's been happening since 2020. Many economies recovered quickly on paper, but for a massive section of the population, it never recovered at all. The pandemic-era recession was different from typical financial crises. It was what economists call a negative real economic shock, meaning it ravished the physical economy rather than collapse in financial markets. And the precision matters because it didn't hit everyone equally. In 2008, it was irresponsible banking practices that caused Wall Street to implode, with devastating knock-on effects leading to a global recession. In 2020, it was don't go outside and interact with other humans. Clearly apples and oranges. Naturally, industries requiring in-person contact were devastated. Tourism and hospitality collapsed. At the same time, video conferencing services saw explosive growth. The industry was projected to expand from $2 billion in 2019 to over $78 billion by 2030. Zoom became a verb. Peloton became a pandemic darling. Meanwhile, airlines were hemorrhaging cash and hotels sat empty. The ability to work from home became the single biggest predictor of economic outcome. High-income earners in tech, finance, and consulting logged in from home and kept earning. Their expenses actually dropped. No commute, no office lunches, no dry cleaning. Many saved more money during the pandemic than they'd ever done before. Underpaid service workers were less fortunate, however, suffering mass layoffs. Now, there was no remote option for cleaners, bartenders, and hairdressers. And when these jobs did come back, they often came back with worse conditions, more precarious hours, and no benefits. By mid-2021, US unemployment data was spelling out these divergent fortunes in black and white. Employment for high-wage workers earning over $60,000 a year had increased by around 10% from pre-pandemic levels. For low-wage workers earning less than $27,000, employment was still down 23%. The upper arm still climbing, the lower arm still in the toilet. And there's your K-shape in a single data point. The asymmetric shock demanded a response, and central banks and governments deployed the standard crisis playbook. Slash interest rates, buy assets, inject fiscal stimulus. The goal was preventing total economic collapse, which, by most measures, they achieved. But using broad-based tools in an already unequal economy meant the benefits flowed disproportionately upward. Central banks cut rates to near zero and launched massive quantitative easing programs. Now, most people hear quantitative easing and think of Jerome Powell manning a money printer, and that's a decent shorthand. But to understand where the benefits flow, you need to know where that money goes. So the Fed creates a new digital money and uses it to buy financial assets on the open market, specifically US Treasury bonds and mortgage-backed securities. And at its peak, the Fed was buying $120 billion worth of these assets every single month. The purchases happen through Wall Street megabanks and investment firms authorized to trade directly with the Fed. They sell the Fed these assets, and in return, their accounts are awash with this new money. It's worth noting that since this money is so fresh, it hasn't even been devalued by the inflationary effect of all that printing. That kicks in later as the massive influx of new dollars spreads through the economy, prompting the price of everything to increase, before ultimately circulating into the hands of the peasant masses. Inflation for you, but massive spending power for the banks, first in line at the money printer. Anyway, those institutions need to deploy that new cash somewhere, and the destination tends to be financial assets like stocks and corporate bonds. And here we have the intended transmission mechanism. Fed pumps dollars into Wall Street uses the dollars to buy more assets, pumping financial markets. Green candles abound, the wealth effect kicks in, and widespread spending and confidence throughout the economy supposedly follow. The Fed is basically giving Wall Street pocket money, ruffling its hair and saying, "Here you go, son, go buy some stocks." And that's fantastic news for the wealthiest 10% of Americans, who hold 87% of the stock market. Asset appreciation makes the wealthy wealthier, giving them more capital to reinvest. Meanwhile, the masses who have to sell their time to get money can only watch asset prices climb further out of reach. And that means the entry price for wealth building keeps rising. At the same time, fiscal policy played out similarly worldwide. Wealthy governments with strong balance sheets deployed massive stimulus packages. Meanwhile, emerging economies with less fiscal headroom couldn't match that spending. A study by the National Bureau of Economic Research compared the two, and found that in wealthy countries with robust policy support, business failure rates actually fell below normal levels during the pandemic. But In emerging markets, failures still rose significantly despite whatever support governments could afford. Within wealthy countries, the targeting of stimulus was often pretty poor. The same study concluded that the majority of fiscal support went to firms that weren't at immediate risk of failure. And this often happens in a crisis. Money flows where it's fastest and easiest to deploy, which means larger established firms with existing banking relationships and not necessarily the masses of smaller businesses teetering on the edge. And these policies stabilized the financial system and prevented a depression, but the mechanics of how they worked, flooding the system with liquidity, supporting asset prices, broad-based stimulus, meant the benefits flowed to the wealthy. The net worth of the richest people in the world doubled in just 2 years. During the pandemic, they made, on average, $1.3 billion per day, or about $15,000 per second. Meanwhile, the income of 99% of humanity fell, with around 163 million people newly pushed into poverty in the same period. Now, the pandemic and the policy response to it accelerated the split, but they didn't create it because, newsflash, the rich getting richer and the poor getting poorer didn't start in 2020. The foundations for the current trend were laid decades earlier through automation, technological change, and mounting inequality that was already baked into the system. Automation has been hollowing out the middle of the labor market for 40 years. Middle-skill, routine jobs, clerical work, repetitive manufacturing, data entry started disappearing in the 1980s. Advances in computing meant machines could perform the same work more cheaply, leaving much of the workforce wrecked without a recession in sight. Research by 2 MIT economists attributes 50 to 70% of the changes in US wage structure since 1980 to this process. Automation displacing workers from routine tasks, pushing them either up into high-skill cognitive work or down into low-wage service jobs. The middle was vacated by technological advances, deleting jobs at a rapid clip. Europe experienced similar automation pressures, but research found that the impact on overall income inequality was smaller there than in the US, and this was due to stronger tax and welfare systems absorbing more of the shock. Similar K-shape, but different outcomes depending on the institutional framework. The pandemics accelerated this trend dramatically. Companies that had been considering automation suddenly had no choice. They needed to operate with fewer people on site. A digital transformation that might have taken 5 years got compressed into 5 months. And once those systems were in place, they didn't get removed when the pandemic ended. There was also the matter of what's being called the digital divide, reinforcing inequality. World Bank data from 2022 showed over 90% of people in high-income countries used the internet. In low-income countries, only 25% did. And this gap existed within countries too, not just between them. During the pandemic, an estimated 90% of high-income students regularly logged in to do online instruction. Only 60% of low-income students managed to do the same. The long-term cost of this learning loss is projected to reduce lifetime earnings for affected students by between $61,000 and $82,000. Come 2020, the global economy was already approaching feudal levels of wealth inequality. The richest 10% of the global population owned 76% of all wealth, and the poorest 50% owned just 2%. In the US, between 1989 and 2022, the top 1%'s share of the total wealth rose from 23% to 27%, whereas the share owned by the bottom 50% stayed flat at just 6%. When you look at it this way, the economy has been K-shaped for a very long time already. The pandemic just turbocharged this in ways we can now spot in macroeconomic data. You can see the K-shape clearly in data on how people spend, how businesses perform, and who ends up carrying the weight. Consumer spending split in 2 distinct different tiers. Moody's Analytics found that the wealthiest 10% of Americans became responsible for nearly half of all retail spending post-pandemic, the highest share in recorded history. Airlines started citing resilient demand from wealthier travelers in their earnings calls, while noting more and more empty seats in economy. In India, overall television sales declined, but Sales of the most expensive models, screens 55 inches or larger, jumped by 18%. The euro area's post-pandemic recovery was notably weaker than America's, largely thanks to private consumption that never quite bounced back. And there's your lower arm of the K-shape staying down. At the same time, companies like Chipotle and Procter & Gamble reported increased price sensitivity among lower-income customers. Consumers were trading down, switching to cheaper options or skipping purchases entirely. Delinquency rates for auto loans and credit cards in the US have climbed steadily this year, exceeding pre-pandemic levels. And this is most prominent among Gen Z and millennials, whose wages haven't kept up with rising costs. Meanwhile, the corporate world showed the same split. Large-cap companies had better access to capital and dominant market positions. In 2024, S&P 500 ETFs attracted $150 billion in net inflows, much of it pouring into the Magnificent Seven of Silicon Valley giants. Small businesses weren't so fortunate. Bankruptcies rose to levels not seen since 2011. Companies catering to lower-income consumers struggled particularly hard. Take First Brands Group, for example. They were a US car parts manufacturer serving lower-income drivers who keep older cars running, and their customer base got squeezed, meaning they got squeezed and ended up filing for bankruptcy. Age had become a significant predictor of financial resilience. Older consumers had accumulated savings and owned homes that had appreciated substantially. Gen Z and millennials, on the other hand, were up to their eyes in student and credit card debt, making wages that couldn't keep pace with the cost of essentials. Globally, regional inequality patterns varied dramatically. The World Inequality Report showed Europe as the most equal region, where the top 10% of earners took home 36% of income. In the Middle East and North Africa, the most unequal region, that same top 10% took home 58%. Put simply, the post-pandemic recovery happened through assets, and if you didn't own any, you probably didn't recover. Even inflation started drawing a K-shape. The headline Consumer Price Index is an average, which makes it misleading. Lower-income families spend much higher share of their income on necessities, housing, utilities, food, transportation, and when the prices of these essentials rise faster than luxury goods or services, the effective inflation rate for poor households ends up significantly higher than the official number. Any wage gains they might have got eroded by costs they couldn't avoid. Now, if it makes you feel any better, the K-shaped economy is just a more honest way of describing the same thing that happens after every economic shock. The mechanisms change, but the outcomes, prosperity for some, stagnation for others, keeps recurring under specific conditions. The most relevant example is the aftermath of the 2008 financial crisis. Central banks deployed quantitative easing for the first time on a massive scale. The policy stabilized the financial system and prevented a complete collapse, but the benefits flowed overwhelmingly to the top. Pew Research tracked the distribution of wealth gains in the US from 2009 to 2011. Every single dollar of aggregate wealth gained during that period went to the richest 7% of households. The bottom 93% saw their net worth decline. Classic K-shaped recovery. They got the aggregate numbers used as shorthand for the economy growing on paper, whilst the majority of people got poorer. You can go back to the 1920s and find similar dynamics. From 1923 to 1929, easy monetary policy fueled a massive stock market bubble. Prices more than tripled, creating enormous wealth for those who own stocks. Meanwhile, other sectors like agriculture struggled with falling prices and mounting debts. The economy split into those benefiting from the financial boom and those left behind. And that divergence ended in the 1929 crash, which turned out to be a rather definitive way of resolving the imbalance. Pandemics themselves have played different roles throughout history. Historically, catastrophic plagues acted as what scholars call great levelers. The Black Death in the 14th century killed such a huge proportion of the labor force that the surviving workers could demand higher wages. Labor became scarce and valuable, while landowner wealth fell, so the plague actually compressed inequality. Modern pandemics work differently. The good news is that huge chunks of the population don't just drop dead so easily nowadays. The bad news is that this means wages stay low and working people have to keep busting their asses just to get hired at some underpaying workplace that's already planning on how to automate away their job. The IMF studied recent pandemics, SARS, H1N1, MERS, Ebola, Zika, and found they were consistently followed by increases in income inequality. The pattern held across different diseases and different countries. But the IMF also found something important about the policy response. Episodes of fiscal austerity after a pandemic were associated with an inequality increase 3 times larger than episodes with supportive fiscal policy. Cutting spending after a crisis makes the divergence worse, a kind of damned if you do, damned if you don't. But at least it's not hard to see why governments instinctively reach for stimulus rather than austerity. Now, there is a counterexample worth examining. The period from the late 1940s to the early 1970s is sometimes called the Golden Age of Capitalism or the Great Compression. High economic growth combined with decreasing inequality. The benefits of rising productivity were broadly shared rather than concentrated. And this was the result of specific policy choices, highly progressive taxation with high top marginal rates, strong trade unions with real bargaining power, strict financial regulation that limited the returns to capital relative to labor, and major public investment in infrastructure and education. That framework created broadly shared prosperity for 3 decades. Then it was dismantled piece by piece, starting in the 1980s, and inequality began climbing again. It was an exceptional period in world history in many ways, and proves that the K-shaped outcome isn't always inevitable. It's the product of how economies are structured and what policies are in place. The bad news is that the current economic structures and policies have been baked into a K-shaped tin, and the situation isn't likely to improve anytime soon. The IMF, perhaps trying to avoid causing panic, describes the outlook as, quote, steady but growth, marked by, quote, resilience amid divergence. That's a roundabout way of saying the K-shaped is the new normal. Their own 5-year ahead growth forecast sits at its lowest level in decades. Meanwhile, the World Bank projects that average global GDP growth in the 2020s is on track to be the slowest of any decade since the 1960s. Slow growth, widening gaps, increasing fragility. Of course, AI is likely to exacerbate that existing trend. There is a wild card here, though, because AI also threatens high-income members of the professional managerial class, whose interests are much more better represented in government than those of the working class. We'll have to wait and see who, if anyone, gets some form of protection or recourse. Maybe this time around, a different set of winners will emerge. For now, though, you can learn more about whether AI is in a bubble by watching our latest video on that right over here. That's all from me now. Thank you guys very much for watching, and I'll see you in the next video.